wire hits your account, the number is real. And for the first time in your career, the question is not, when will this be worth something? You waited years for this. The IPO priced, or the tender offer closed, or the acquisition went through. And then it arrives, and there's no manual for the part that comes after. Here's a strange thing I see over and over. People who waited years for a liquidity event freeze for the next 3 months and quietly make some of the most expensive mistakes of their financial lives. So today I'm going to give you a 90-day action plan in the exact order the decisions need to happen. The tax move comes first because they have hard deadlines. Diversification comes next because the risk is concentrated and the clock is running. Then the cash flow and lifestyle questions. And finally, the longer-term setup for whatever comes next. If a liquidity event just happened to you, or you can see one coming, this one is for you. Let's get into it. Start here because this is the mistake that costs the most. The single most common liquidity event error is spending money the government already owns. Here's how it happens. A big vesting event or a stock sale generates a tax bill, and what gets withheld almost never covers it. RSUs that vested on IPO are typically withheld at the federal supplemental rate. And for most Bay Area tech employees, that rate sits well below their actual top marginal rate once you stack federal, California, and the extra Medicare and investment income taxes on top. That difference is called the withholding gap, and at this scale, it can be enormous. A huge number lands in the account. People assume the taxes were handled. They start spending. And then April shows up with a bill for several $100,000 more than they set aside. So your first move is not investing, it's arithmetic. Estimate your real all-in tax on the event, compare it to what was actually withheld, and set the difference aside in cash before you do anything else with the money. The reason this is the 30-day job and not the 90-day job is deadlines. Quarterly estimated tax payments have fixed due dates, and underpaying triggers penalties even if you pay in full by April. And if your event involved exercising incentive stock options, the alternative minimum tax can apply to the spread, which is a calculation you want done early, not discovered late. Get a tax projection done now while there is still time to act on it. Now, if your event left you holding stock instead of cash, you own a different problem. You own a concentration problem, and it has a deadline attached. The instinct here is always to hold. The stock got you this far. Holding feels loyal, and selling feels like a bet against the company, plus a tax event you would rather not trigger. But as I covered in the piece on why holding your company stock is not a strategy, a large single stock position is a decision whether or not you make it on purpose. And after a liquidity event, that position is usually bigger relative to your net worth than it has ever been, which means the risk is bigger too. The move is not to sell everything in a panic, and it is not to hold out of inertia. It is to pick a target. Decide what percentage of your net worth you are willing to keep in the stock, and then build a schedule to get there over time. A preset selling plan, written down in advance, takes the emotion and the market timing right out of it. And if you are still inside a post-IPO lockup, the plan starts the day the lockup ends, not the day you happen to feel ready. One more thing. Taxes shape the order here too. The holding period that separates short-term from long-term gains can change your rate, and there are ways to soften the cost of diversifying, which I covered in the piece on selling concentrated stock without a giant tax bill. Coordinate the selling plan with your tax projection so the two are not working against each other. This next step is the one people either skip entirely or blow through in a single weekend. Both are mistakes. Here's the part that surprises people. A liquidity event does not have to change your monthly life at all, and in the first 90 days, it probably should not. The temptation is to upgrade everything at once. The house, the car, the spending, because you have arrived, right? The problem is that lifestyle costs are permanent and the windfall is not. A bigger house brings a bigger mortgage, higher property taxes, and more fixed costs every single month. And that quietly raises the bar for what the rest of your money has to do for the rest of your life. So separate the one-time decisions from the recurring ones. Paying off high-interest debt, funding a real emergency reserve, making one large purchase. Those are one-time uses you can absorb. Permanently raising your monthly burn is the decision that deserves the most scrutiny and the least speed. Give the big lifestyle moves a deliberate waiting period inside those 90 days instead of committing in the first emotional weeks. And try to translate the windfall into what it actually buys you, which is usually optionality, not stuff. That number on the statement is really a certain amount of future flexibility. The ability to take a lower paying role, to start something, to step back. Spend it on fixed costs and you trade that flexibility away before you have even decided whether you want it. Okay, with the urgent items handled, the last stretch is about building the structure the money now requires. This is the moment to max out the tax-advantaged accounts you might have been neglecting, including the strategies I covered on sheltering an extra amount each year in a Roth. A liquidity event year is often exactly when that contribution and conversion math is most worth running. It is also when to revisit your whole investment plan because the diversified proceeds need a destination, not just an exit from the old position. And two longer-term pieces tend to show up for the first time right here. The first is estate and beneficiary basics. Most people in their 30s and 40s have never set this up, and it suddenly matters when there are real assets behind it. A will, updated beneficiary designations, the right titling. Not glamorous, but it is the difference between a plan and a pile. The second is charitable giving. In a high-income liquidity year, this can be one of the most tax-efficient moves available, especially when you give appreciated stock instead of cash. None of this has to be finished by day 90. The goal of the last month is just to have the structure started and the right people in place so the next chapter is something you designed instead of something that happened to you. So here is the bottom line. A liquidity event is not the finish line. It is a 90-day window where a handful of decisions made in the right order determine how much of the windfall you actually keep and what it ends up buying you. Cover the tax bill first. Set a diversification plan with a real schedule. Hold your lifestyle steady while you think. And use the final month to build the longer-term structure the money now deserves. If you want to talk through your specific situation, the link to schedule a call is in the description. And if you haven't subscribed to Vested yet, my weekly newsletter for Bay Area tech professionals, the link for that is down there too. I'll see you next week.